What are the long-term risks of money supply growth from key? Imagine a river that keeps flowing faster and faster. At first, it helps water the fields and keeps everything moving. But if it gets too strong, it can cause floods and damage the land. That's similar to what happens when central banks keep increasing the money supply through quantitative easing. Quantitative easing is when central banks buy government bonds and other financial assets to put more money into the economy. They do this to lower long-term interest rates and encourage borrowing and spending. But if they keep doing this for a long time, there are some risks to watch out for. One major risk is inflation. When more money is chasing the same amount of goods and services, prices tend to rise. This is because the extra money can push prices higher over time. Evidence shows that after long periods of quantitative easing, producer prices often go up, especially for companies with high debt. These companies face higher borrowing costs and may pass these costs onto consumers by raising prices. This can make inflation more persistent and harder to control. Another issue is that not all firms are affected equally. Companies with a lot of debt tend to raise their prices more because they face higher interest expenses. On the other hand, firms with little or no debt might not change their prices much. This uneven effect can create a patchwork of inflation, making it more complicated for policymakers to keep prices stable. Financial markets can also get distorted. When central banks buy large amounts of long-term safe assets like government bonds, it reduces the supply of these assets. This can cause the risk premium, what investors demand for taking on risk, to go up. It might lead to mispricing of risk, asset bubbles, or excessive risk-taking, which can threaten financial stability over time. Reversing these policies can be tricky too. When central banks want to tighten money supply again, they have to sell assets and reduce liquidity. This process, called quantitative tightening, can be slow and cause volatility in long-term interest rates. That makes it harder to control inflation and keep the economy steady. Long-term growth in the money supply can also influence government borrowing costs. Lower interest rates make it easier for governments to borrow more money, which might lead to bigger deficits and more debt. While this can support spending in the short term, it raises concerns about fiscal sustainability and future inflation if debt levels grow too high. If the economy is already running hot, increasing the money supply can push demand beyond what supply can handle. This demand pull inflation can become persistent if supply chain issues or shortages exist, making inflation harder to tame. Lastly, when interest rates are already very low, further efforts to stimulate the economy through quantitative easing may lose effectiveness. This can lead to diminishing returns and increased risks of inflation without much economic growth. To manage these risks, central banks need to carefully calibrate their quantitative easing programs. They should gradually normalize policies and coordinate with fiscal authorities. Keeping a close eye on inflation signals and financial market conditions helps avoid unintended long-term inflation. In the end, while increasing the money supply can support growth temporarily, doing it excessively over time can lead to inflation becoming a persistent problem, distort financial markets, and make policy reversal more difficult. It's a balancing act that requires constant vigilance to keep the economy stable and healthy.